Most traders believe their biggest enemy is being wrong. It isn't. Being wrong is part of the game. The real damage begins when you refuse to admit it. Let me ask you something. How many times have you watched a small loss turn into something much heavier, something that sat in your account like a quiet weight? Not because the market surprised you, but because you hesitated. Because you gave it just a little more room. That hesitation, that's where accounts begin to bleed. You see it every day in the market. A trader enters with conviction, maybe even discipline. The setup looked clean. The risk was defined. Everything was aligned, until price moved against them. And then something shifts. Not in the market, in the trader. Have you noticed how quickly confidence turns into negotiation? First, it's "I'll give it a bit more space." Then, it might come back. Then silence. Why does that happen? Because taking a small loss feels like failure, but holding a losing position feels like hope. And hope is far more comfortable than discipline, at least in the moment. Here's the part most people don't want to hear. The market doesn't punish you for being wrong. It punishes you for staying wrong. Think about that carefully. If you cut a loss quickly, what happens? The damage is contained. Your capital remains intact. Your mind stays clear. You're still in control. But if you don't, what happens next? The loss grows. Your judgment becomes clouded. You stop seeing the market as it is and start seeing it as you want it to be. And now, you're no longer trading. You're defending a mistake. Is that really a position you want to be in? There's a quiet law in trading. Small losses are manageable, large losses are emotional. And once emotion enters, logic exits. So why do traders let losses grow? Because they're focused on being right instead of being effective. Let me turn that back to you. Are you trying to prove something to the market, or are you trying to extract money from it? Those two goals don't coexist. Now let's break this down practically. A trade goes against you. Not violently, not dramatically, just enough to invalidate your original idea. Maybe the level you relied on breaks. Maybe momentum shifts. Maybe volume tells a different story. At that moment, the market is giving you information. Do you listen or do you argue? Because every second you stay in a trade that no longer makes sense. You're not trading your system. You're trading your ego. And ego is expensive. Cutting a loss quickly is not about reacting emotionally. It's about acting decisively. There's a difference. Emotional traders panic out of trades. Disciplined traders exit when their reason for entering no longer exists. Can you tell the difference in your own behavior? One is fear. The other is clarity. Let's talk about cause and effect. If you cut losses quickly, you create a system where no single trade can harm you significantly. Over time, this allows your winning trades, however few, to outweigh the losses. But if you hold on to losing trades, even occasionally, you introduce asymmetry in the wrong direction. One mistake can erase 10 good decisions. Does that sound familiar? That's not bad luck. That's structural weakness. Here's something subtle most traders overlook. The market rewards consistency in behavior more than brilliance in prediction. You don't need to catch every move. You don't need to be right all the time. But you do need to behave consistently when you're wrong. So ask yourself, when a trade fails, do you respond the same way every time? Or does it depend on how you feel in that moment? Because inconsistency in exits is where most strategies quietly fail. Now let's get even more practical. What should you look for? Watch how price behaves around your entry. If it hesitates where it should move, pay attention. If it breaks a level you relied on, don't rationalize it. If the market structure changes, don't ignore it. These are not suggestions. These are signals. And signals are meant to be acted on, not debated. What should you avoid? Avoid adding to a losing position just because it's cheaper. Avoid widening your stop because might bounce. Avoid waiting for break even just to feel better. Let me ask you, does the market care where you entered? No. So why are you anchoring your decisions to a number that only matters to you? Cutting losses quickly requires something most traders don't develop early enough: acceptance. Acceptance that being wrong is normal. Acceptance that losses are part of the process. Acceptance that control comes from action, not prediction. Without that acceptance, Every loss feels personal. And when something feels personal, you hesitate. And hesitation, in this game, is costly. There's a rhythm to professional trading that many never quite grasp. Enter with a plan. Observe without bias. Exit without hesitation. Simple. Not easy, but simple. And the most important part of that rhythm is the exit. Because entries can be adjusted. Strategies can evolve. But if you don't control your losses, none of that matters. Let me leave you with a question to sit with. What would your trading look like if every losing trade was cut immediately, without debate, without delay? Not perfect exits, not flawless timing, just clean, decisive acceptance. How much capital would you still have? How much mental clarity would you regain? And more importantly, how differently would you approach your next trade if you knew that no single mistake could truly hurt you? The moment your reason for entry disappears, your exit should follow. Simple idea, but rarely practiced with consistency. Most traders don't struggle with finding entries. They struggle with letting go when those entries no longer make sense. Think about your last few trades. You didn't enter randomly. There was a reason. Maybe a breakout level, a support holding, a shift in momentum, or a pattern completing. Something told you, now is the moment. But what happens when that reason quietly fades? Not dramatically, not with a sharp move, just enough to signal that the market is no longer aligned with your idea. Do you act on that signal, or do you hesitate? Because this is where the real decision is made, not at entry, but at invalidation. Every trade is built on a premise. You are not buying or selling just because price exists. You are acting on an expectation. Price should behave a certain way if your idea is correct. It should hold a level, accelerate in your direction, or at least not contradict your logic. When it fails to do that, the trade is no longer what you thought it was. And yet, most traders stay. Why? Because they shift their focus from the reason they entered to the price they paid. The trade stops being about structure, momentum, or behavior, and becomes about avoiding a loss. That shift is subtle, but costly. You stop evaluating the market and start protecting your ego. Let me ask you, if you had no position, would you enter the same trade at this exact moment? If the answer is no, then why are you still in it? That question alone can change how you manage risk. When your reason for entry disappears, the market is giving you new information. It's not punishing you, it's correcting you. It's telling you that your initial rid was incomplete or early. And that's fine. What matters is how quickly you respond to that update. Delaying the exit doesn't improve the trade. It only increases exposure to something you no longer understand. There's also a psychological trap here. Traders often wait for confirmation to exit, the same way they waited for confirmation to enter. But exits don't work the same way. By the time you get clear confirmation that you're wrong, the loss is already larger than it needed to be. So instead, you have to act on invalidation, not confirmation. If a level breaks that was supposed to hold, that's enough. If momentum stalls where it should expand, that's enough. If the market structure shifts against your position, that's enough. You don't need a dramatic move to justify an exit. Quiet contradiction is sufficient. And yet, many traders ignore these early signals because they're uncomfortable. It feels premature. It feels like giving up too soon. But what they don't realize is that small, early exits are what create long-term stability. Staying in a trade after your reason has disappeared turns a controlled decision into an uncontrolled situation. Now you're no longer trading a plan. You're reacting to price. And reactions are rarely consistent. Consistency comes from rules. And one of the most important rules is this: the trade exists only as long as the reason exists. The moment that reason is gone, the trade is no longer valid. Not weaker. Not maybe. Just invalid. And once you start operating with that level of clarity, something changes. You stop negotiating with the market. You stop searching for reassurance. You begin to act with a kind of quiet decisiveness that most traders never develop. The market doesn't trap you. You trap yourself by staying. That idea goes against what most traders feel in the moment. It's easier to believe the market is doing something to you, that it's unfair, unpredictable, even targeted. But if you slow down and look closely, you'll notice something uncomfortable. The market moves. You decide to stay. A position doesn't become dangerous the moment it goes against you. It becomes dangerous when you stop managing it. When you stop making decisions and start waiting instead. Have you ever said, "It'll come back," without any real reason behind it? Not based on structure, not based on behavior, just a quiet hope that price will reverse because you need it to. That's not the market trapping you. That's you refusing to leave. Every trade begins with control. You choose the entry. You define the risk. You decide the size. In that moment, everything is clear. But control is not something you establish once. It's something you maintain. And the moment the trade starts moving against you, that control is tested. What do you do when things stop going your way? Because this is where the trap is built. Not by the market, but by hesitation. By the small decisions you delay. By the signals you ignore. By the story you start telling yourself to justify staying in a position that no longer makes sense. The market doesn't lock the door behind you. You're free to exit at any time. But instead of walking out, many traders stand still, watching the loss grow, waiting for permission to leave. Why do you need permission? If your trade idea is no longer valid, what are you waiting for? There's a subtle shift that happens when a trade goes wrong. At first, you're observing. Then you're hoping. Then you're defending. And once you start defending a position, you're no longer objective. You're emotionally invested in proving that you weren't wrong. And that's where the real trap is. Because now, every tick against you feels personal. Every move becomes harder to process clearly. You start ignoring new information because it contradicts your position. You hold on not because the trade is good, but because exiting would mean admitting a mistake. Let me ask you something. What's more costly, accepting a small mistake, or protecting it until it becomes a large one? The answer is obvious when you're calm, but in the moment, it rarely feels that way. That's why discipline in trading isn't about intelligence, it's about behavior under pressure. When price moves against you, you're given a choice. Exit and reset, or stay and hope. One keeps you in control, the other slowly takes it away, and the longer you stay in a bad trade, the more your options shrink. At first, you can exit easily. The loss is small, the decision is clean. But as the trade moves further against you, something changes. The loss becomes uncomfortable, then it becomes painful. And now, exiting feels harder, not because you can't, but because you don't want to realize the damage. So you stay longer, and in doing so, you tighten the trap around yourself. It's not the market doing this. The market is simply moving, as it always does. The trap is built from your own resistance to act. There's also a dangerous illusion here. Many traders believe that time will fix a bad trade. That if they just wait long enough, price will return, and sometimes it does. But that doesn't make the decision correct. It just reinforces bad behavior. Because now you've learned the wrong lesson, that holding and hoping works. And the next time, you'll do it again. Until eventually, one trade doesn't come back. And by then, the damage is no longer small. So let's bring this back to something practical. A trade moves against you. The level breaks. The behavior changes. The reason you entered is no longer present. In that moment, you are not trapped. You are free to act. The only question is, will you? A losing trade held too long becomes a psychological burden, not just a financial one. At first, it's just a number on the screen. A small drawdown. Manageable. Something you tell yourself you can handle. But give it time, just a little more time, and that number starts to carry weight. Have you ever noticed how a single open loss can follow you around, even when you're not looking at the chart? That's where it stops being about money. In the beginning, your mind is clear. You're reading price, evaluating behavior, thinking in probabilities. But as the loss grows, something shifts. Your focus narrows. You stop analyzing the market as a whole and start fixating on one position. You're no longer asking, what is the market doing? You're asking, when will this trade recover? That's a completely different mindset, and once that shift happens, it affects everything. Your next decisions are no longer independent. They are influenced by the weight of the current loss. You hesitate on new opportunities. You rush trades trying to recover. You avoid closing the losing position because doing so would make the loss feel real. Let me ask you, how many of your bad decisions came from trying to fix a previous one? Because that's how the burden spreads. A single trade, if managed poorly, doesn't stay isolated. It leaks into your thinking. It distorts your judgment. It changes how you see risk. And without realizing it, you begin trading from a place of pressure rather than clarity. That pressure builds quietly. You check the trade more often. You feel tension when price moves. You start calculating how far it needs to go just to get back to break even. Every small movement becomes significant, not because it matters to the market, but because it matters to you. And the more it matters, the less objective you become. Why does that happen? Because humans are not wired to handle unresolved loss comfortably. The mind wants closure. It wants resolution. But instead of taking a controlled loss and moving on, many traders choose to keep the position open, hoping the market will resolve it for them. That hope comes at a cost. While the trade remains open, your mental capital is tied up, your attention is divided. You are not fully present for new opportunities because part of you is still stuck in the past decision. And trading requires presence. You can't read the market properly if your mind is occupied elsewhere. You can't act decisively if you're already carrying doubt from a previous mistake. That's how one losing trade begins to affect multiple outcomes. It's not just about the loss anymore. It's about the state of mind it creates. Let's look at behavior. When a trader is holding a losing position for too long, they often become reactive. They interpret every small move as meaningful. A minor bounce feels like relief. A small drop feels like danger. Their emotional state starts to mirror price movement. That's not control. That's attachment. And attachment is dangerous in trading because once you're attached to a position, you stop seeing alternatives. You stop asking whether your capital could be used better elsewhere. You stop evaluating the market objectively. Your entire perspective becomes centered around one trade. Is that really where you want your focus? A professional mindset treats each trade as independent. Win or lose, it's just one outcome in a long series. But when you hold on to a losing trade too long, you break that independence. Now the trade is no longer just a trade. It's a problem you're trying to solve. And trading is not about solving problems. It's about managing risk. The longer you carry that problem, the heavier it becomes. And here's the part most traders overlook. Closing a losing trade quickly doesn't just protect your capital. It protects your mind. It clears space. It resets your focus. It allows you to approach the next opportunity without emotional residue. Without that reset, you're always slightly off balance. So when you find yourself holding on to a loss, it's worth asking, what am I really holding on to here? Is it the trade itself, or the discomfort of admitting it didn't work? Discipline in exits matters more than precision in entries. That's not what most traders want to hear. The focus is almost always on finding the perfect setup, the cleanest pattern, the strongest signal, the exact timing. Entry becomes an obsession. But what happens after the trade is placed is what actually determines the outcome. Think about it. You can have an average entry and still come out ahead if your exit is handled well. But a perfect entry, managed poorly, can still end in a loss. So where is the real edge? Most traders believe it's in prediction, in knowing where the market will go next. But prediction is uncertain. Even the best setups fail. The difference is not in avoiding losses, it's in controlling them. Let me ask you, how often have you entered a trade correctly, only to give back the advantage because you didn't manage the exit properly? That's more common than people admit. An entry is just a starting point. It gives you a position, but the exit defines the result. And yet, exits are often treated as an afterthought, something to deal with later, something flexible. That flexibility is where inconsistency begins. When you enter a trade, you usually have a clear reason. There's structure, logic, alignment. But when it comes to exiting, many traders rely on feeling. They wait, they watch, they hesitate. They don't act until the situation forces them to. Why? Because exiting requires accepting uncertainty. You might leave too early. You might miss further profit. You might be wrong again. And that discomfort leads to delay. but delay has consequences. A disciplined exit means you act when your conditions are met, not when your emotions are ready. If your reason for the trade disappears, you exit. If your risk level is reached, you exit. If the behavior changes, you exit. No debate. No negotiation. Can you say you do that every time? Because if not, then your results are not coming from your strategy. They're coming from your reactions. And reactions are inconsistent by nature. There's also a deeper layer to this. Precision in entries gives you confidence. It feels like control. But control at the beginning of a trade means very little if you lose it during the trade. What matters is how you behave when things don't go as planned. Do you follow your rules, or do you adjust them? Do you accept the outcome, or do you try to influence it after the fact? Because once you start adjusting your exits based on how you feel, you've stepped away from discipline. And without discipline, even a strong strategy weakens. Look at traders who survive long term. They don't rely on perfect entries. They rely on consistent behavior. They know that some trades will fail, and they are prepared for that. Their focus is not on avoiding losses, but on making sure losses stay small. That's a subtle but important difference. If you chase perfect entries, you'll always feel like you're close to something better. But if you focus on disciplined exits, you build stability. You create a system where no single trade can cause serious damage. Which one sounds more sustainable? Because trading is not about occasional success. It's about repeated behavior over time. And repeated behavior must be controlled. This is where many traders get trapped. They improve their entries, refine their setups, learn new strategies, but their exits remain inconsistent. So the overall result doesn't change. They're solving the wrong problem. The real problem is not where you enter. It's how you respond after you enter. Once you understand that, your focus shifts. You stop chasing perfection and start building discipline. You stop trying to predict every move and start preparing for when you're wrong. And that preparation is what keeps you in the game. Because in the end, the trader who survives is not the one who enters best, but the one who manages risk best. Every extra second in a bad trade is a vote against your own system. You may not think of it that way in the moment, but that's exactly what's happening. You built a plan, defined your rules, decided what conditions make a trade valid. And then, when those conditions disappear, you choose to stay anyway. What does that say about your system? More importantly, what does it say about your trust in it? A trading system is not just a set of entries. It includes how you manage risk, how you respond to failure, how you exit when things don't go your way. And when you ignore those parts, even briefly, you're no longer following a system. You're improvising. Let me ask you, why create rules if you don't intend to follow them under pressure? Because it's easy to follow rules when things are going well. When the trade is in profit, discipline feels natural. But the real test comes when price moves against you, when doubt starts to creep in, when your initial idea begins to weaken. That's when your system matters most. And that's when most traders abandon it, not all at once, but gradually. First, you delay the exit. Just a little. Then you justify it. It hasn't moved that far. It might still work. Then you start adjusting your expectations. What was once a clear invalidation becomes something you're willing to tolerate. Do you see how subtle that shift is? You're not breaking your system in a dramatic way. You're bending it, quietly, slowly, until it no longer has structure. And each second you remain in that trade, you reinforce that behavior, because actions shape habits. If you stay in a losing trade longer than your rules allow, you are training yourself to ignore your own framework. You are teaching your mind that rules are flexible when it matters most. What happens the next time you're in a similar situation? You'll hesitate again. Not because you don't know what to do, but because you've practiced not doing it. This is how inconsistency builds. Not from lack of knowledge, but from repeated small decisions that go against your plan. Every extra second becomes a small act of doubt. You are telling yourself, maybe my system isn't right. Maybe I should wait. Maybe this time is different. And once doubt enters, clarity fades, because now, instead of executing, You're evaluating in real time, under pressure, with emotion involved. That's not where good decisions are made. A system is designed to remove that pressure, to give you clear actions when uncertainty appears. But it only works if you trust it enough to follow it without hesitation. So let's make this practical. Your system defines a level where the trade is no longer valid. Price reaches that level. At that exact moment, you have a choice. Exit and reinforce discipline, or stay and weaken it. It seems like a small decision, but it compounds over time, because trading is not just about outcomes, it's about behavior patterns. If you consistently exit when your rules say so, you build confidence, not in the market, but in yourself. You know that no matter what happens, you will act according to your plan. But if you delay, even occasionally, that confidence erodes, and without confidence in your own system, every trade becomes uncertain. You start second-guessing entries. You hesitate on exits. You look for external validation. You lose the internal structure that keeps your decision-making stable. All from staying in a trade a little too long. It's not the size of the loss that causes the damage, it's the break in consistency. That's what most traders miss. They think the problem is financial, but the deeper issue is behavioral. Because once your behavior becomes inconsistent, your results will follow. So when you're in a losing trade and your system tells you it's time to exit, understand what's really at stake. It's not just that one trade. It's the integrity of your entire approach. Cutting losses quickly protects both capital and clarity. Most traders understand the first part. Fewer truly appreciate the second. Capital is obvious. It's measurable. You see it in your balance, in your drawdown, in the size of your positions. When you cut a loss early, the numbers stay controlled. The damage is limited. You live to take the next trade without pressure. But clarity, that's less visible and far more important. Let me ask you, have you ever noticed how different your thinking is after a clean loss versus a prolonged one? When you exit quickly, there's a sense of finality. The trade is over. You can review it, learn from it, and move on. Your mind resets. You're ready to observe the market again without bias. But when you hold on to a losing trade, something lingers. Even if you're not actively watching it, part of your attention remains tied to it. You're not fully present. You're divided between what is happening now and what you hope will happen next, and that division reduces clarity. Because clear thinking requires space. It requires detachment. It requires the ability to see the market as it is, not as you need it to be. A lingering loss interferes with that. At first, it's subtle. You check the trade more often. You feel a slight tension when price moves. You hesitate on new setups because you're already exposed. You become cautious, but not in a disciplined way, in a distracted way. Do you recognize that state? You're still trading, but not with full focus. And that's where mistakes begin to multiply. Because clarity is not just about understanding the market, it's about having the mental capacity to act on that understanding. When your mind is occupied, even partially, your reactions slow down. Your decisions become less precise. You miss signals or you misinterpret them, all because one trade wasn't closed when it should have been. Now consider the opposite. You take a loss quickly. It's small. It's contained. There's no need to monitor it anymore. Your capital is intact and your attention is free. What happens next? You start scanning again. You observe price action without attachment. You evaluate setups objectively. You're not trying to recover. You're simply participating. That's clarity. And clarity leads to better decisions. It's a chain reaction. Quick exit, preserved capital, clear mind guide better execution. But if you delay the exit, the chain reverses. Lingering loss, divided attention, emotional pressure, poor execution. Which chain do you want to operate within? Because you can't have both. There's also an important psychological shift here. When you cut losses quickly, you reinforce a mindset of control. You're telling yourself that you are responsible for managing risk, not avoiding it. You accept that losses are part of the process, and you deal with them efficiently. That builds confidence. Not the kind of confidence that comes from winning, but the kind that comes from consistency. And that confidence stabilizes your behavior. But when you hold on to losses, you create uncertainty. You don't know when you'll exit. You don't know how large the loss might become. You don't know how it will affect your next decision. That uncertainty clouds judgment. It introduces hesitation, doubt, and inconsistency. And once those enter your process, clarity fades even further. So cutting losses quickly is not just a defensive move. It's a proactive one. It sets the stage for everything that follows. It keeps your mental environment clean, your attention sharp, your decisions grounded. Without it, even a good strategy can feel chaotic. With it, even a simple approach can become effective.